Forex Fundamentals and Trading. Chapter 3, Exchange Rate Mechanics. Section 1, Bid and Ask Prices. Every Forex quote contains two prices, not one, and that is one of the first habits traders need to build. The bid is the price at which the dealer is willing to buy the base currency from you, while the ask is the price at which the dealer is willing to sell the base currency to you. In a quote like Euros USD, the base currency is euro, so both prices refer to euros. The bid is shown on the left, and the ask is shown on the right. If you keep your attention on the base currency, quotes become much easier to read. One side tells you what happens if you sell the base currency, and the other tells you what happens if you sell the base currency, and the other tells you what happens if you buy it. The simplest way to read any Forex quote is to ask yourself, what am I doing with the base currency? If you are selling the base currency, you transact at the bid. If you are buying the base currency, you transact at the ask. Traders often say you hit the bid when selling and pay the ask when buying. So with Euro/USD, selling euros uses the left-hand price, and buying euros uses the right-hand price. That single rule clears up a lot of confusion, especially when you begin opening and closing trades. The labels bid and ask are named from the dealer's perspective, not yours. The dealer's bid is the price the dealer is willing to pay for the base currency, and the dealer's ask is the price the dealer charges to sell that base currency. Because the dealer buys lower and sells higher, the bid is normally below the ask. This gap is not a mistake in the quote. It is how the market is priced. It also explains why closing a trade means using the opposite side of the quote from the one you used to enter. A buy position entered at the ask is later closed at the bid, while a sell position entered at the bid is later closed at the ask. Once you can identify the bid and ask, finding the spread is straightforward. Take a quote such as Euro/USD 1:10.50 and 1:10.53. The bid is 1:10.53, the ask is 1:10.53, and the spread is the difference between them, which is 0.3 in most major currency pairs. That equals 3 pips. Traders treat that spread as a basic transaction cost because it is built into every market order. Before you think about profit, you first need to know what the trade costs to enter and exit. A new trade usually begins slightly negative because of the spread. If you buy, you enter at the ask, but if you had to exit immediately, you could only sell at the bid. If you sell first, you enter at the bid, but to get out right away, you would have to buy back at the ask. In both cases, the difference between entry and immediate exit is the spread. That is why break-even is not the same as the market simply standing still. The market must move in your favor enough to overcome that initial cost before the trade shows a profit. Consider a practical example with GBP USD WOSTED at 1.29.0 and 1.29.0 and 29.0 Thai. If you buy £10,000, you enter at the ask, so your entry price is 1.29.02. Suppose the quote then changes to 1.29.09 and 1.29.0. Even though the market appears to have moved only slightly, you would exit your long position at the bid, which is 1.29.0. That means you lose 3 pips from entry to exit. On a 10,000 unit position in GBP/USD, that is about a $3 loss, showing how the spread can outweigh a small move. This is why spread cost matters when planning a trade. If your target is only a few pips away, the spread can consume a large share of the potential gain before the trade even has room to work. A target smaller than the spread is especially problematic because the cost may be larger than the reward you are aiming for. Wider spreads make very short-term trading much harder for that reason. Good trade planning always looks at net opportunity, not just gross price movement. In other words, the expected move has to be large enough to justify the spread, the risk, and the effort of the trade. Spreads are not fixed by nature. They change with market conditions. In active markets, where many buyers and sellers are competing, spreads are often tight. During major news releases, uncertainty rises and dealers may widen spreads sharply to protect themselves from fast-moving prices. The same thing can happen during thin trading hours, when fewer participants are active. Less liquid pairs also tend to have wider spreads even in normal conditions. So, when you see a spread widen, it is often telling you something important about liquidity, risk, or both. Many beginner mistakes come from reading only one side of the quote or forgetting that the spread affects the whole trade. A very common error is thinking the bid is the price you buy at, when in fact a market buy uses the ask. Another is ignoring the spread when judging break-even or setting a very small target. Traders also get into trouble by assuming every pair has roughly the same spread, which is not true at all. Conditions can change quickly during stress, low liquidity, or off-hours trading. A good habit is to check both sides of the quote and ask yourself exactly where you enter, where you would exit, and what that spread is costing you. Try applying these rules to a live USD/JPY quote. First, write down the exact bid and ask as they appear, because even a small difference matters. Then subtract the bid from the ask to find the spread, remembering that for yen pairs 1 pip is usually 0.01. After that, say out loud which side you would use to buy USD/JPY and which side you would use to sell it. Finally, estimate the cost for a 100,000 unit position by combining the spread in pips with the approximate pip value. Doing that on real quotes is one of the fastest ways to make bid, ask, and spread feel natural instead of theoretical. Section 2. Spreads. A spread is the gap between the two prices in a Forex quote. The bid is the price you can sell at, and the ask is the price you can buy at. The spread is simply ask minus bid, and it is usually measured in pips. That gap is not just a technical detail on the screen. It is one of the most basic trading costs in Forex. If euros est 9.1050 and 1.1950 and 1.1052, the spread is 2 pips. Every trader needs to be able to spot that cost instantly before deciding whether a trade is worth taking. Reading a quote becomes easy once you consistently identify left as bid and right as ask. Suppose Euro/USD is quoted at 1.1050 and 1.53. The bid is 1.1050. The ask is 1.1050. The ask is 1.1053. And the spread is the difference between them, which is 0.0003 in most major pairs. 1 pip is 0.00. So that difference equals 3 pips. That is why traders often focus on the last meaningful decimal place when discussing spreads. A quote is not just showing where price is, it is also showing the cost of trading right now. Every market order starts behind because you enter on one side of the quote and could only exit on the other side. If you buy, you pay the ask, but your immediate exit would be at the bid. If you sell, you receive the bid, but your immediate exit would be at the ask. That difference creates a small unrealized loss the moment the trade opens. The size of that loss is the spread. So before a position can break even, price has to move enough in your favor to cover that built-in cost. A spread that looks small on the screen can still have a meaningful effect, depending on the market and your trade size. Major pairs often have tighter spreads because they are heavily traded and usually more liquid. Exotic or less liquid pairs often have wider spreads because there are fewer participants and more pricing risk. Even with the same spread in pips, the money cost grows as your position size increases. That means traders cannot judge cost by the quote alone. They have to combine spread with size. A 1 pip spread on a very large trade matters much more than the same spread on a very small one. Brokers generally offer either fixed spreads or variable spreads, and the difference affects how trading costs behave. A fixed spread stays the same under normal conditions, which can make costs easier to anticipate. A variable spread changes throughout the day, often narrowing when liquidity is strong and widening when conditions are uncertain. During active hours, variable pricing can be very competitive. But around news events or quiet sessions, it can become much wider than expected. So the better model depends not only on the broker, but also on your style, your timing, and how sensitive your strategy is to changing costs. To estimate spread cost in money terms, start with the quote itself. First, calculate the spread in pips by subtracting the bid from the ask. Then find the pip value for your specific position size. Once you know both numbers, multiply spread in pips by value per pip. For example, if the spread is 2 pips and your pip value is $1 per pip, the spread cost is about $2. This is a very practical habit because it turns an abstract number on the screen into a real cost you can compare with your target and stop. The spread in pips can be identical, while the money cost is very different. Imagine GBP/USD is quoted at 120.31 run 3, which is a 3 pip spread. On a micro lot where the pip value is about 10 cents, that spread costs roughly 30 cents. On a standard lot where the pip value is about $10, the same 3 pip spread costs about $30. Nothing changed in the quote except your trade size. That is why experienced traders always think about spread in both pips and money, not just one or the other. Active traders care deeply about spread because they face the cost over and over again. A longer-term trader targeting a large move may notice the spread less, because it is small relative to the total expected gain. A scalper or short-term trader often targets only a few pips, so the spread can take a large bite out of each opportunity. If trades are frequent, the cost accumulates quickly across the day or week. Even a strategy with a decent win rate can struggle if spread cost is too high. This is why active traders often choose the most liquid pairs and the busiest trading hours. Many spread-related mistakes come from treating the spread as an afterthought. Traders often set profit targets without subtracting trading costs, which makes the plan less realistic than it appears. Another mistake is assuming spreads stay stable all the time, when in reality they can widen suddenly during news or quiet periods. Some people compare brokers only by commission and ignore the all-in cost created by spread plus commission together. Others place market orders without even checking the current spread first. A disciplined trader looks at the quote before entry and asks whether current conditions still support the trade idea. Before trading, it is useful to compare spread conditions across several pairs. Record the bid and ask for each pair. Calculate the spread in pips, and then convert that spread into money for your normal position size. This quickly shows which pair is cheapest or most expensive to trade right now. It also encourages a better question: why is one spread wider than another? The answer may involve low liquidity, time of day, upcoming news, or the fact that the pair is across or exotic. That short review can prevent you from entering a trade with far more friction than you intended. Section 3. Pips and watts. Pips and lots matter because price movement alone does not tell you how much money is at risk. Pips measure how far price has moved, while lots measure how large your position is. You need both to estimate profit, loss, and overall exposure. The same 10-pip move can be tiny on a micro lot and significant on a standard lot. So when traders talk about risk, they are really combining movement and size. That is what turns a market move into a real financial result. A pip is the standard unit used to describe exchange rate movement. For most currency pairs, 1 pip equals 0.0000. So if US-USD moves from 1,050 to 110.51, that is a move of 1 pip. If it moves from 110.50 to 110.51, 10.6 DAT, that is a move of 10 pips. Using pips gives traders a clean way to talk about price changes without repeating long decimals. It also makes it easier to compare setups, calculate risk, and discuss performance across different pairs. Not all currency pairs use the same pip format, so it is important to know the exceptions. For yen pairs, 1 pip is usually 0.01 rather than 0.01. That means a move in USD/JPY from 110.50 to 110.51 is 1 pip. Many brokers also quote an extra decimal place, which is called a pipette, or 1/10 of a pipe. For example, on Euro/USD quoted to 5 decimals, the final digit is a pipette, not a full pip. Traders usually speak in full pips, but platforms often display pipettes for more precision. A lot is the standardized size of a Forex trade, and it determines your exposure. A standard lot is 100,000 units of the base currency, a mini lot is 10,000 units, and a micro lot is 1,000 units. As lot size increases, each pip becomes worth more money. That means larger positions can create larger gains, but also larger losses from the same price move. The market may move the same number of pips, yet the financial outcome can be very different depending on the lot size chosen. This is why lot selection is really a risk decision, not just a sizing convenience. On Euros USD, pip value is especially easy to understand when the account is in US dollars. because the quote currency is also US dollars. A standard lot is typically worth about $10 per pip. A mini lot is about $1 per pip. A mini lot is about $1 per pip. And a micro lot is about 10 cents per pip. So if Euros USD moves 15 pips, the money result depends directly on which lot size you are trading. The movement is the same, but the account impact is not. This is one reason Euros USD is often used when introducing pip value. To calculate profit or loss, begin with the pair's pip size. Then combine it with your lot size. After that, find the value of 1 pip for that position. Once you know the pip value, multiply it by the number of pips the market moved. For example, if you trade 10,000 units of Euro/USD, 1 pip is about $1. A move of 25 pips would therefore produce about $25 of profit or loss. This process helps traders translate market movement into money before they ever place the trade. Pip value is not always fixed in your own account currency. First, the pip value is determined in the quote currency of the pair. If your account uses a different currency, you then need to convert that amount using the current exchange rate. That means the same pip move can be worth a slightly different amount as exchange rates change. For a USD account trading a pair quoted in USD, the math is straightforward. But for a Euro or Yen account, an extra conversion step may be needed before you know the true account impact. Take a simple example with GBP USD. Suppose you buy one mini lot at 1/30 thousandths, and the price rises to 132.5. That is a gain of 25 pips. On a mini lot, the pip value is about $1 per pip, so the total profit is about $25. If you had traded a standard lot instead, the same 25 pip move would be worth about $250. The market did exactly the same thing in both cases, only the position size changed. Here is a useful yen pair example. A USD account buys one standard lot of USD stage APY at 110.50 and exits at 111.00. The move is 0.50. 50, which equals 50 pips because yen pairs use 0.0 fan per if5. For a standard lot, the pip value is 100.00. 0.1 core pip. Multiply 50 pips by 1, €00, or 1, €0 yen per pip. Multiply 50 pips by 1 to express that in a USD account, divide by the exchange rate at exit, giving about 450, $45. Most mistakes in this area come from mixing up quote conventions and money risk. Traders sometimes confuse pipettes with full pips and end up overstating or understating the size of a move. Another common error is using 0.0000 brew 01 for yen pairs, when the correct pip size is usually 0. 0.1. People also forget to convert pip value when the account currency differs from the quote currency. And many beginners focus only on pips without considering watt size, even though the watt size determines the actual financial risk. The safer habit is to ask 2 questions every time: how many pips and how much money per pip. Section 4, Liquidity and Volatility. Liquidity refers to how easily a currency pair can be bought or sold without moving the price very much. In a highly liquid market, there are many active buyers and sellers, so orders tend to fill quickly and close to the expected price. In a less liquid market, even a moderate order can push price more noticeably. That is why liquidity is closely linked to execution quality. High liquidity usually means smoother trading conditions, while low liquidity often means wider spreads, more slippage, and less predictable fills. For traders, liquidity is not just about activity. It is about how stable the market remains when orders hit it. Volatility describes how much and how fast prices move over time. A low volatility market tends to drift in smaller steps, while a high volatility market can swing sharply in a short period. So volatility is about both size and speed. A pair that moves only a few pips each hour feels very different from one that jumps 30 or 40 pips in minutes. Volatility itself is not good or bad, but it changes the level of opportunity and risk. Traders need to judge whether current movement fits their strategy and tolerance for uncertainty. Liquidity and volatility often interact, but they are not the same concept. Liquidity is about how easily trades are absorbed, while volatility is about how much price moves. A market can be very liquid and still highly volatile, especially when important news causes heavy two-way trading. A thin market can also appear calm for a while, then suddenly jump because there are not many resting orders to absorb flow. Low liquidity makes prices more fragile, but it does not automatically mean constant motion. Keeping the two ideas separate helps you read market conditions more accurately. Market depth helps explain why some orders barely move price while others create sharp jumps. Liquidity is not just one number. It depends on how many buy and sell orders exist across different price levels. In a deep market, there are many available counterparties at several nearby prices, so larger trades are absorbed more smoothly. In a shallow market, there may be only a few orders available, so the same trade can push through multiple levels and move price quickly. This is why traders care about the strength of the order book, not just the last traded price. Deeper markets usually behave in a more orderly way. Liquidity is usually strongest when major financial centers are open and overlapping. London, New York, and Tokyo are especially important because they bring the largest concentration of participants into the market. The London and New York overlap is often the busiest period of the day for major pairs. During these active hours, spreads are often tighter and execution can be smoother. Major pairs such as USD, USD, JCBY, and GBPV, USD usually benefit the most from this broad participation. By contrast, quiet hours often come with lower activity, wider spreads, and less reliable fills. Thin markets can be risky precisely because they sometimes look calm. During holidays, late on Fridays, or when major centers are closed, there may be fewer resting orders in the market. That means even modest buying or selling can push price farther than usual. Spreads may widen and slippage becomes more likely because there are fewer counterparties available at nearby prices. A quiet chart in these periods does not necessarily mean low risk. It may simply mean the market is fragile and waiting to react sharply to relatively small flow. Volatility can reduce liquidity because fast price movement makes market participants more cautious. When prices start jumping, dealers and liquidity providers may widen spreads or reduce the size they are willing to quote. That means the market becomes thinner just when traders most want smooth execution. As a result, the next wave of orders can move price even more. This creates a feedback loop where volatility scares off liquidity and lower liquidity amplifies volatility further. Understanding that cycle helps explain why markets can feel stable one moment and disorderly the next. The same pair can behave very differently depending on the time and conditions. USD's JPY during a busy US session after a major jobs report may still trade with a relatively tight spread because there are many active participants and deep liquidity. The price can be volatile, but the market often absorbs orders smoothly. In off hours, the spread may widen significantly, and even a modest order can cause a sharp jump. So one environment is volatile because of heavy information flow, while another may be volatile because of weak liquidity. Looking only at direction misses the more important question of how the market is functioning underneath. Traders can watch a few practical clues to judge liquidity and volatility in real time. The bid-ask spread is one of the simplest signals. Narrow often suggests better liquidity, while wide may suggest caution. The speed of price movement also matters, because fast jumps usually indicate rising volatility. Measures such as average true range can help quantify how much a pair has been moving. If volume or market depth data is available, that can add useful context about how much participation is behind the move. Together, these clues help you decide whether conditions match your plan before you commit capital. A common mistake is assuming a quiet market is automatically a safe market. In reality, thin conditions can hide execution risk and sudden jumps. Another mistake is forgetting that spreads on even major pairs can change depending on the time of day. News can also alter both liquidity and volatility at once, which makes old assumptions unreliable in seconds. Large trade size becomes especially dangerous when the market is thin, because price impact and slippage grow quickly. Better decisions come from matching your timing and position size to the actual market environment, not the one you wish were there. A practical way to understand these ideas is to compare one pair across 2 sessions. Record the spread during a busy period such as London, and also note the average hourly range. Then do the same during a quieter session such as Sydney. You may find that London offers tighter spreads and larger movement, while Sydney has wider spreads and less room for price to travel. That combination can make the quieter session harder to trade, especially for short-term strategies. Exercises like this train you to judge trading conditions from evidence rather than from habit. Section 5. Price movements. A currency pair moves because supply and demand between the two currencies is constantly changing. If a pair rises, that means demand for the base currency has strengthened relative to the quote currency. If it falls, demand for the base has weakened relative to the quote. Every Forex trade is an exchange of one currency for another, so price always reflects that relative balance. These shifts do not come from one single force. They come from expectations, news, capital flows, positioning, and order flow all interacting. The market is always repricing what traders believe about the two currencies. The biggest drivers of currency movement are usually macroeconomic rather than company-specific. Interest rate expectations matter especially because higher expected returns can attract capital into a currency. Economic data, such as inflation, jobs, and growth, can change how traders view future policy. Risk sentiment also matters, because investors often favor different currencies in calm periods than in stressed periods. On top of that, technical levels can influence short-term behavior as traders react to support, resistance, and breakout points. Price movement is often the final result of all these forces combining at once. Forex prices can move very quickly because the market responds almost immediately to new information. Some of that information is scheduled, such as inflation releases, jobs reports, or central bank decisions. Other information arrives unexpectedly through headlines, comments, or geopolitical developments. Different traders may interpret the same event differently, which creates rapid two-way trading while the market searches for a new fair price. During that process, liquidity providers may widen spreads because uncertainty is higher. So fast movement is not random. It is often the visible result of information being absorbed in real time. Short-term moves can take different forms, and the shape of the move tells you something about the market. A spike is a sudden, fast move in one direction, often triggered by news or a burst of orders. A gap is a jump from one price level to another with little trading in between. A whipsaw is especially tricky because the market makes an initial move and then sharply reverses. Thin liquidity can exaggerate all three patterns by making price travel farther with less order flow. Recognizing these patterns helps you judge whether you are seeing genuine follow-through or just temporary imbalance. One of the most important skills in trading is separating noise from trend. Short-term noise often comes from headlines, stop orders, low liquidity, or temporary order imbalances. Those moves can be sharp, but they do not always reflect a lasting change in the market's outlook. A broader trend usually develops over days or weeks as expectations change around growth, inflation, interest rates, or risk sentiment. That does not mean trends move smoothly, only that their direction is supported by a deeper narrative. Good traders ask whether a move is just motion or whether it represents a meaningful repricing. A price move usually unfolds as a sequence rather than a single event. First, new information reaches the market, whether from data, headlines, or policy signals. Then traders and algorithms react by placing orders, which shifts supply and demand. Liquidity providers respond by adjusting their bids and asks, and sometimes widening spreads if uncertainty rises. If key stop levels are triggered, those extra orders can accelerate the move. After that burst, the market reassesses and price may stabilize, continue in the same direction, or reverse part of the move. Consider a headline-driven move in USD CAD. Suppose the pair starts near 1,3600, and oil-related news arrives that supports the Canadian dollar. Because a stronger Canadian dollar tends to push USD CAD lower, the pair may drop quickly to around 135.50 on the initial reaction. As traders respond, spreads can widen and liquidity may thin, which affects how smoothly the market trades. If more selling follows and stop orders are triggered, the move can extend further, perhaps toward 135.2. This kind of example shows that the headline may start the move, but liquidity and follow-through often determine how far it actually goes. A simple post-news review can teach you a lot about price behavior. Start by marking the exact release time on the chart, because even a few minutes matter. Then measure the first 30-minute range and compare it with the pair's recent average hourly range. That tells you whether the reaction was unusually large or fairly normal. After that, check whether price continued in the same direction or reversed as more participants digested the news. Also note whether spreads widened, whether comments followed the release, and whether the market was reacting to a surprise or just confirming expectations. Many mistakes in reading price action come from ignoring context. Traders often confuse correlation with causation and assume one market move must have caused another when the link is not clear. Others overread tiny price changes that may simply be normal noise. Time of day and liquidity also matter, because the same chart pattern can behave differently in a deep market than in a thin one. Chasing a breakout after most of the move has already happened is another common problem. And even in a real trend, normal pullbacks happen, so a brief reversal does not automatically mean the trend is over. The key idea is that price movement is the market's real-time response to information, expectations, and order flow. Price reflects supply and demand, but the path it takes is shaped by liquidity and the way orders arrive. Macro news and policy expectations often influence direction, while order flow and market depth influence how smooth or violent the move becomes. So reading price well means asking more than just whether the market went up or down. You want to understand what likely caused the move, how the market processed it, and whether the move looks more likely to continue or fade. Context gives meaning to motion,